Hi, my name is Laurent Meunier from Safe Pacific Financial, and if you are familiar with us, you know that we have an extensive experience with participating whole life policies that are used in advanced strategies like infinite banking or immediate financing arrangement, and we've been doing this for more than 10 years. A key benefit to these types of strategies is your ability to grow wealth in a safe and secure manner. But how do you grow your wealth? By purchasing life insurance. Oftentimes when people think of life insurance, they think of it as an expense or another bill. However, with the participating whole life insurance, your premiums go into a fund called a participating account that's managed by the insurance company. And then the money from this account is invested, usually conservatively. And then as a result, your cash value or the amount of premiums that you pay into your policy grows with the dividend that's paid from that participating account. So today, we're going to be discussing what sorts of things that participating account invests in, and then why these investments are more conservative in nature, and then how the dividend that's paid to the policyholder is determined. First up, what is the money that you're putting into this policy invested in? The participating accounts from the insurance companies in Canada, they typically invest in a diversified range of assets, which would be like fixed income, securities, equities, and actually more and more alternative investments now. The precise mix of assets varies depending on each company's tolerance and risk. The fixed income securities like government bonds or corporate bonds, they provide a stable income stream, and they're usually less volatile than the equities. So this makes it an attractive investment for participating accounts. Then the equities offer the potential for a higher return over the long term, but they also are subject to greater volatility. This means they go up and down more. And then many participating accounts also invest in alternative assets, which is generally like real estate or infrastructure, private equity. And this diversifies their income and could offer lower volatility than the traditional equity investments. And so for example, a company like Canada Life has a huge real estate portfolio, about $4.8 billion in 81 different properties. So they invest in both commercial buildings, office buildings, industrial complexes, and even residential apartments. And their real estate investments are primarily located in Canada, but they've also got investments in the US. And this is a fairly common practice across the big life insurance companies in Canada. And so we're here in Vancouver. So if you walk around downtown, you'll notice many buildings that are named after various insurance companies, such as the Canada Life building or Manulife building or Sun Life building. And then odds are that these properties were bought using funds from that company's participating account, from money from those participating account holders. The specific investment strategy that's employed by the participating accounts is typically managed by an experienced investment professional team. They have like a rigorous and disciplined process. So they really want to mitigate their risks and they want to diversify, so they want to be safe. Overall, the participating accounts, they offer access to a professionally managed investment portfolio that usually aims to deliver sustainable returns over the long term while not being too risky or volatile. Life insurance companies have been able to consistently reach this and to continue to pay dividends to policyholders by investing conservatively for the long term. And not only this, but they do this because the life insurance policies are typically long-term contracts that require the insurance company to pay out benefits to the policyholders or the beneficiaries sometime usually far in the future. And then to meet this obligation, they need to invest the premiums in assets that generate stable, predictable returns over the long term while minimizing the risk of loss. By investing conservatively, this helps the insurers achieve the objectives by focusing on assets that offer low volatility and liquidity at the right time. So using this example above about Canada Life, the insurance company may invest in real estate because it provides a long-term income stream and it has generally lower volatility than traditional equities. Also, the insurers are required by law to maintain a minimum capital surplus to ensure that they can always meet the obligations to the policyholders. So how do they calculate the dividends? I've actually got a whole video on this, and you can find it on our website or it's on our YouTube channel. But the short version is that they calculate these dividends based on several factors, which includes the investment performance of the account, managing the expenses that are associated with the account, and then also the mortality experience of the policyholders. And the investment performance is a key factor, right? So if the account generates positive investment returns, which it often does, given how conservatively it's invested, a portion of that return is allocated to the policyholders in the form of a dividend. And so historically, over more than the last 100 years, the major Canadian insurance companies have consistently paid a dividend to policyholders every single year. Some larger companies like Canada Life or Manulife, they've been paying dividends for more than 150 years, right? So that is longer than the country. As you can see, the money that you put into your participating whole life policy in the form of premiums is safely and securely invested in order to generate a consistent and sustainable return over the long term. Right now in Canada, you can expect a dividend rate of 5 to 6% depending on the company that you're working with. That is it for today. So if you found this video valuable, please let us know in the comments. Also, hit that like, hit that subscribe, share it with a friend. And if you want to discuss any of this, if you want to set up a participating whole life policy for yourself, reach out to me. You can go on our website. It's safepacific.com. There'll be a link below. In there, fill out the form. It comes to me. We'll reply within 24 hours during business hours. That's it for me today, and I will see you later.